Hello everyone and thank you for tuning into OptionGig. Today is April 4th when I'm recording this, and the topic for this session is assignment risk on a short call trade. We recently finished the quarter 1 of 2020 and many ETFs and the stocks had declared their quarterly dividend. So one of a person whom I coach on option trading reached out to me because he had received an email from their stockbroker saying this ETF is going X dividend and you have a short call on it and it may be at risk of assignment. So that person reached out to me and asking, how do I know if I could be assigned? So I guided that person and then I thought, why not share it with the whole option gig community? So this is the episode. So we got a good content for you. So don't go anywhere and we'll get right into it after the introductory music. So stay here with me. Hello everyone, welcome to Option Gig. This is your host Vivek, part-time option trader and full-time worker, husband and father. If you also want to generate consistent monthly income trading options while working in your regular day job, then join me in this journey. Alright everyone, welcome back. The topic we're gonna talk about is assignment risk on a short call trade. Without any further ado, let's jump right into it. Let's first explain what a short call trade means. A short call means you have sold a call option. That means you have given the buyer of the call option a right to call the shares from you. That's essentially what a short call is. When you sell a call option, you are giving a right to someone else to call the shares from you. If you have the shares, it is called a covered call. If you don't have a shares with you, it is called a naked call option. But in both the cases, it is a short call option trade. Alright, so in generally, the assignment will happen based on these criteria. Number one, if your option is in the money, then it could be at risk of assignment. I'm not saying that it will always be, but it could be at risk of assignment. Secondly, the criteria is the option is getting closer to expiration. So generally I've seen that most of the assignments happen in the last week of the expiration period. So if you are doing monthly option trades which is set to expire on third Friday of the month, you would see that in the third week probably a lot of assignments will happen on your short call option trades or even on short put option trades. So this is what the general guideline is, that when the assignments could happen. First, the option needs to be in the money, because if it is out of money, why would anyone be exercising their right on that call option? Doesn't make sense. Secondly, if it is closer to expiration, means there is not much extrinsic value left in it. So then in that case, there is chance for getting assigned. So in the money, closer to expiration is what the general criteria is. But then there are some exceptions. Now let's review some of the exceptional circumstances, some of the unusual cases in which a short call option may be at a risk of assignment. So first unusual case or an exceptional circumstance is there is an upcoming dividend. This is what exactly happened with that person who wrote to me because he had an ETF and he got an email from the stockbroker saying you have a short call on an ETF is about to go ex dividend, so your option trade may be at risk of assignment. Now why would it be a risk of assignment? Because the owner of the long call means the person on the other side of the trade, that person may want to capture the dividend. It means they need to have the shares in their account before the share goes ex-dividend. So that is why they may exercise their right to call the shares from you, and hence they will own the shares and they will be able to receive the dividend. So even if the option expiration is a few weeks away, but if they want to get the dividend, they need to have the shares in their account. And that's the reason why your short call may be at a risk of assignment if there is an upcoming dividend. Remember, I said maybe, and we will understand in what cases there is no risk of assignment. Secondly, if the short call option trade is deep in the money. If it is deep in the money, there is no extrinsic value left in that trade. Owner of the long call option will not lose anything if they exercise it. So even if the trade is 3 or 4 weeks away from expiration, if it is already very deep in the money, then why wait for another 3 weeks or 4 weeks to acquire the stock? The owner of a long call option may just want to exercise and get the stock. So these could be some of the exceptional circumstances in which your short call trade may get assigned early. All right, now let's look into each of these types of the risk and evaluate if it is indeed at a risk of assignment, and if yes, then what you should do. Let's first look into the assignment risk due to dividend. How can you check whether your short call trade is at risk of assignment because there is a dividend upcoming on it? The ways to check this are: number one, you can check how much is the extrinsic value still left in the short call trade. Remember, if the person on the other side of a trade is exercising their right to call the shares from you, they are losing the extrinsic value which is still left in the trade. They have to close the trade while it still has some extrinsic value left in it. So you need to check how much of the extrinsic value is still left in the trade. Because if the extrinsic value in the trade is less than the dividend that is upcoming, then your trade is at high risk of assignment. Because the person will lose the extrinsic value, but they will gain more in the dividend. So in net, it is profitable transaction for them to call the shares, lose the value in extrinsic, but get more value from a dividend. So net profitable. So if your dividend is more than the extrinsic value, then there are high chances, almost 100% chances that your trade will get assigned. Okay. Now, if your broker platform does not show the extrinsic value, the other way to look at it is look for the price of the put option at the same strike price as a short call option. If the price of the put option is less than the amount of the dividend upcoming, then you are at high risk of assignment. So you can look at either the extrinsic value or you can look at the price of the put option. In both cases, if it is less than the amount of dividend, then your trade is at high risk of assignment. Let's look at the assignment risk due to trade being in the money. Now, if the short call trade is deep in the money and the extrinsic value is closer to zero, then there is a greater risk of assignment because the long call buyer is not losing anything by exercising their right, because extrinsic value is very close to zero. So why would they want to wait for another few weeks? Rather, they'll just get the stock right now. So if it is deep in the money and extrinsic value is closer to zero, then there is a greater risk for assignment. All right, now let's look at what you can do if that happens. Nothing to panic. Your stock portfolio was already behaving as if you had short stock, as if the assignment had happened. So you will not see much change in your stock portfolio, just that the short call will be replaced by short stock, and then you need to manage it quickly afterwards. Okay, now let's look at what to do once the assignment happen. What to do if your trade is at risk of assignment. You got to manage the trade. Means if you have a naked call, then you can close a position if you do not want to hold a short stock position. Because if you have a naked call, means your call option is not covered by the amount of shares, means you do not hold the shares in your account. In that case, when your trade is assigned, you will have a short stock position. Now, if you are not comfortable in holding the short stock position, because you may think that the stock could go up and you lose, then you should just close the trade. You should just buy back the call option that you sold and close the trade. No short call, no risk of assignment. Okay. But if you have a covered call and if you do not want your shares to be called away, then you should close the position. But if you are okay for your shares to be called away, then just sit tight, do nothing. But if you want to retain the shares because now you may start to have a seller's remorse, then you should just close your short call trade by buying back the call option. The third could be just do nothing if assignment fee is zero, because you are okay to hold the short stock position, or you are okay to have your stock called away and the assignment fee is zero, so you do not lose any money because the trade has been assigned. Then just do nothing. Your broker will take care everything for you, so you can just sit back and relax. All right, so I hope this was useful. Next time if you get an email from your stockbroker that your trade could be at a risk of assignment, you can change that could be to a confirmed decision by going through this decision criteria. As always, if you have any further questions on this or on any other topics related to option trading, drop me a note at optiongig@gmail.com, or if you're watching this on YouTube, just post your question in the comments, or if you're listening it on a podcast, you can add that in your feedback and I'll be very happy to respond it to you. Do let me know if there is any other topic that you want me to cover, and I'll bring that topic in our next episode. As always, thank you very much. Stay safe and happy trading. Goodbye. Please note that all the information presented is purely for educational purposes and is not a financial or investment advice. I don't know you, you don't know me, so do yourself a favor and don't invest or trade solely based on what you hear.